To speak more on this, I'm joined now by Ajay Bagga, Chairman of Elements Platforms, a market expert, Sunil Subramaniam, MD and CEO, Sundaram Mutual, Pankaj Murarka, CIO of Renaissance Investment Managers. Welcome to all of you, and thank you so much for speaking with us today. Mr. Bagga, let me begin with your take. We've been speaking on and off about, this massive euphoria you're seeing in the Indian markets. Is it some of the same factors that are leading to new highs? We've now hit 65,000 for the first time ever.
Yeah, definitely, Tamanna. It's a function of good economic performance in India, corporate earnings holding up, and foreign flows turning very well post-March end. We have seen a good inflow from the foreign investors. That is helping our markets. The domestic flows continue. SIPs are giving a strong mooring to the Indian markets. In terms of valuations, we are reaching slightly high valuation zone, but still not at a worrisome level. The worry is more global. I think the trouble will come from the global macro. There, I think things are looking toppish. Things are looking very complacent. Just now, one of the European brokers released a survey of 400 market participants, and nearly 99% have said that they expect a weaker half two after the 13% MSCI World performance. But there, I'll give you an interesting number. I was just reading one of the market commentators. The Apple weightage in the MSCI World Index is now more than the entire UK market. The UK market is at 3.6%, Apple is at 4.7%. In the S&P 500, Apple is at a historical high 7.2%. No single stock has taken that high a level. And so all active managers who are constrained on not being able to take more than 5% exposure in a single stock, they will underperform the S&P 500. And only 22% active managers in the US have outperformed in the first 6 months versus their passive benchmark. So those are the things. The worst case scenario is that it's a combination of 1970s inflation meeting the dot-com bubble kind, which is happening with AI this time. And the answer is not very good. The good prognosis is the central banks manage a soft landing, which seems to be right now happening. And we see through 23 and see a strong 24 for the markets again coming back. That's the good forecast. But the bad one would be stagflationary along with a dot-com kind of wipeout of stock values.
Let's look at it from what's been working so far, and the very important question about valuations. Let me come to you on this, Pankaj Murarka. Are Indian blue chips, the good stuff, just very, very richly valued right now? And is this something that investors should start looking at? We know that banks have been on a tear for a while now. There are other sectors which have been absolutely shining. Are you seeing an overheating in the system?
Tamanna, we have been having this conversation for, I think, 3 or 4 months, and I've been consistently sounding positively biased and constructive on Indian equities. And my faith or views just get reaffirmed every passing day. When you talk about valuations, in the last 20 years, there have only been 4 or 5 occasions, and all of them have been in middle of a crisis, some sort of or other, and I can count them on my fingers, when India's valuation were lower than MSCI emerging markets. India being a high growth market and a relatively high quality market, because ROEs of India are superior to MSCI emerging markets, which is what foreigners benchmark their emerging market exposure to, have always traded at a valuation premium to all the other emerging markets. That valuation premium has varied anywhere between 20% to as high as 60% at different points of time. So the point is, if you're the fastest growing economy in the world, India still will do high teens kind of earnings growth going forward over the next couple of years from a visibility perspective, and it's a high ROE market, then that market will trade expensive in relation to peers, where growth is high single digit or less than that. ROEs are far more inferior. And there are cases, there are issues around stability. People want to take money out of China, and there's no other economy or a market which can absorb that significant amount of capital other than India. So the point I'm trying to say is, while India might look relatively expensive in relation to peers, in relation to India's own trading history over the last 20 years, I think India's valuations are still reasonable. We are around our average valuations of last 20 years. And the other point is, India will continue to remain expensive because it's a high growth market. You cannot buy a high growth market cheaply at all the time. You can buy them cheap only in middle of a financial crisis. 2020 COVID crisis, March of 20, Indian markets were available at 12 times earnings, but no one had the courage to buy it, right? Because there was a fear psychosis, and it was a crisis where it seemed like for a moment that the world will come to an end. So in middle of crisis, you can buy India cheap because there is fear and panic, but otherwise India will continue to remain rich. I don't feel overly concerned about India's valuation at this point of time. And I think given India's growth construct, Indian equities will continue to do well. Given the fact that markets have rallied very sharply in the last few weeks, they might take a pause or a breather, or there could be a short-term reversal or a pullback, but I would count that as more as a healthy correction in a long-term bull market.
Sunil Subramaniam, is this the time for a healthy correction, or is there more steam left? And are investors, retail investors who've been disciplined and stuck to their SIPs, the ones really celebrating right now?
Absolutely, because if you look at the fact that domestic mutual funds have tended to diversify, you talked about the Sensex and Nifty reaching all-time highs, but you take the last 3 months returns, they've just been 9, 10, 11%, Sensex and Nifty, whereas the mid-cap and small-cap is up 20%. So if you look at the SIP book of the domestic, is largely on the flexi-cap, multi-cap space, mid-caps and small-caps. So domestic fund managers have been selling large-cap stocks which valuations have been risen due to FII flows and redeploying that money into mid and small caps. So definitely the domestic investor through mutual funds has got a much larger exposure to the mid and small cap. So they are naturally, benefiting far greater than a pure large cap exposure, which is what the FII population has largely experienced. So yes, I think domestic investors are very happy. And I think the SIP book going up month on month is a good sign. And I would say that before the year is through, we should see at least 20,000 crore SIP book from the current 14,000, because typically retail investors like to top it up when they see good returns. So I think the domestic support of the markets will continue. Are the markets due for a correction? Well, if you look at the last 3 months, right, mutual funds have bought 10,000 crores worth of stocks, but FIIs have bought 100,000 crores. So it's a 10:1 ratio between an FII and a domestic mutual fund. So the FII buying, I think, is largely been driven by the fact that oil is soft. If you track the FII flows into India, you have sovereign wealth funds and pension funds which take long-term bets, but you have hedge funds which are taking tactical calls, and that has been correlated, and I've done a lot of study on this, to oil price trends, right? So when oil price went down during COVID, there was huge influx. Then it went from the $20, $30 right all the way to 125. You saw massive outflows. 90% of the money that came in went out in that 9-month period. Then when oil went from 125 down back to 85, again you saw flash inflows. Then the banking crisis, the Adani factor, was a little bit of a pause. But post-March 15th, you again, because if you recollect, oil got stagnated at about 85 levels when Biden announced the price cap, right? But that was because it was winter. Now that the winter has clearly passed into summer, you're seeing that the heating demand for oil has come down. So oil price expectation to be stable and maybe even head lower towards the 60s is a big boost for a short-term FI like a hedge fund to put in money. So the only risk to the market here, if for some reason, right, you see oil price beginning to rise, then, a pullout by the short-term speculative volatile flows, right, the hot money, as they say, could lead to some amount of profit-taking and correction. But barring that, the fact that the U.S., like, Ajay mentioned, right, they have managed this towards a soft landing, right? To that extent, you will see that the rate hike program has to continue because growth has not really suffered as much. So there's no hard landing, but if the rate hike program continues, ultimately there has got to be a correction. So I think the expected slowdown in the world economy is what is being factored in. And I think Pankaj mentioned this, right? That relatively, see, if you look at an FII, right, he's like a mutual fund manager. He's got a diversified portfolio, and for him, each country is a stock. So India is a high growth, high PE stock, whereas there would be another commodity oriented country like a Brazil, which would be a cyclical stock for them. So there is always a premium to be paid for the certainty of growth. And India, right through the post-COVID phase, once we have recovered from the COVID and we saw the V-shaped recovery, our numbers haven't flagged, right? And you look at the corporate earnings. Last quarter, average was 21%, and you have nominal GDP at 12 to 13%. So corporate earnings are growing at twice the rate of the nominal GDP, which is phenomenal. How many countries can boast of that? So I think to that extent, yes, we are on the cusp of an earnings. From July 10th, you will start the earnings flow in. And the way that pans out could have a little bit of a pause in the market, because if you notice in the previous quarter also, mutual funds were net sellers in the first few weeks of April, in the last weeks of March, because they were waiting to look at the earnings season and how it panned out. And then they brought in the money. So you could see a similar kind of a behavior. While the earnings season plays out, looking at various numbers, there could be some pause as fund managers wait to see the direction of the future. But that being said, we have a festival season coming on. I see consumption a big boost because all through COVID, our per capita GDP has been rising. So I think there is enough consumer surplus available. Auto is clearly demonstrating that the pent-up demand is coming through. Tractor demand in this is also coming through. Again, another risk factor to consider, though I think data is mixed on that, is the El Nino factor, right? It was threatening to be leading to a drought-like situation, but I don't think it's as bad as it looks. And even across the world, Argentina has it bad. I think Brazil had it good. There's been mixed response to El Nino. So that's one aspect that you'll keenly track, because the southwest monsoon will be on during the earnest season. And I think that number, if it turns out to be very drop in the long-term average of monsoon rainfall, then perhaps there could be some kind of a profit booking taking place. But those two factors apart, oil as well as the monsoon, I don't see any other risk factors to India's growth story. And because China and India are the only two 5% plus growth rate economies in the world, clearly India is a preferred destination in China, given the political risks associated with China and what they're going through.
Okay, so the fly in the ointment could be the monsoons, which right now seems like there is a good story going on there, better than expected. That's one of the reasons for the euphoria. Ajay Bagga, if I were to look at the sort of mood switch, and Sunil Subramaniam talked about it, April onwards, where we've seen some hesitancy, dissolve. We've seen good, consistent growth in the markets, etc. Would you put that down to FII sentiment turning and FIIs returning, or is there much more to it?
Success begets its own success, very much, Tamanna, as Pankaj was mentioning, with FIIs coming in strongly. That has led to some amount of re-rating in the markets. But where have they come in? They started it around April, beginning at 17,000 levels, and consistently they bought, including today. So really the FIs have not been an indicator of the market performance. They do tend to have an influence on the markets, but that influence is waning. The fundamentals of the markets have been very strong. That is what has led to this new all-time highs. So there is very little euphoria in that sense. It's one of the more skepticism-driven rally. So most of the market professionals are very skeptical about the longevity and durability of this market rally. I am still in the corner of caution, more because of the global macro, which I described. So I would say that the issue for India will be global, and that will lead to some amount of slowdown for us as well. Hopefully that is at least a year away, and it translates into a very soft landing or a softish landing. That's the scenario we have. Should you put in huge amounts right now? I think the regular investment route is the best for the retail investor. And I have kept saying that for the small cap, mid cap, it's better to go through the mutual fund route because you have a professional picking up. Because now everything is getting bid up, especially on the small cap side. We have seen even very questionable companies running up very fast. That's where the retailers normally come to grief. And that's why I keep saying the mutual fund manager is a better route to play that small cap, mid cap portion of the market.
Pankaj Murarka, we listed out earlier some of the headwinds, possible challenges, some of the mood spoilers, and Sunil Subramaniam talked about a few. What would be on your list? I know you're eternally bullish, but clouds in the horizon that you're looking out for.
Well, Tamanna, before the clouds on the horizon, let me tell you one thing. On the positive side, see, the fact remains global investors are grossly underinvested in China. And last few years, there's a recognition of the fact that China, and which has now been proven, that China's growth has peaked. China is slowing down sharply. And obviously, China is not a free-flowing economy and a free-flowing market. And as a result, investors want to take serious amount of money out of China and reallocate to India. So that's a huge tailwind for India in that sense. One should be, meaning directionally, I don't think so there's any question mark about India's growth and optimism, and one should be positive on India. At the same time, one should be fairly pragmatic and cautious in that sense. And I think this rally equity markets in India and globally will continue through the rest of the year towards the end of the year because investors are underinvested into equities globally and certainly in India as well. In terms of what could be the risk, I think the risk is more to do with execution. In India, we need to execute well our growth plans. Investors really looking forward to India now that we are the fastest growing economy in the world and will continue to remain so over the next 20 years. Investors really want India to execute its growth well and probably accelerate its growth through deepening of reforms. So I would be concerned if there's any reversal in any reforms that are being pursued by the government, or if India, or if there's some sort of a question mark on longer-term India growth story, which I don't think so is going to be the case. So the risk to India is all about execution, policy making and execution, I would say. As long as we can get a policy making right and we can execute well, I think India's story is here now for a very long haul. All of us sitting in India are grossly underestimating our potential as Indians and for Indian economy and consequently for Indian markets as well.
So that, larger narrative of the India story and the growth of the India story is well in place. But where it gets tricky is the minutiae. How do you ensure you're making the most of it right now? And what would be your advice, Sunil Subramaniam, for those who want to load up? Are valuations too high right now? Should they wait for a bit and see if there's going to be a cool off? What would your advice be?
So I would say that if you look, the stock market delivers returns in two ways to investors. One is what is fundamentally called as a value in the sense of the EPS growth expectations, right? And I think I think Pankaj laid it out very well, that nobody is questioning the economic fundamentals, and a nominal GDP growth of 12 to 13% should easily translate to corporate earnings growth of 13 to 15%. So I don't think there's an issue with the returns being delivered from the increasing EPS growth. I think that's a given. The problem is the flows, right? The flows coming in and out. Now, domestic flows are there, but like I just mentioned for this quarter, domestic mutual funds have bought 10,000 crores, FIs bought 1 lakh crores. So I think the fact that something like 40% of the free float of the Indian stock market lies with FIIs means that you got to look at that number to decide whether in a short to medium time frame, in the medium to long term time frame, the fundamentals will drive the value accretion in the Indian capital markets. I don't think anybody needs to worry that over a 5, 10, 15-year period, any investor, regardless of what level he comes in, will make healthy double-digit returns over the long term. But for the short to medium term, if I may describe that as up to 3 to 5 years, if you look at the flow patterns, right, and I will just point out some statistics here to help people to judge whether the market. So first of all, at of the year, you ask market pundits, right? They were all of the view, right? In January, if you just go back and rewind and look at all the predictions, everybody said, equities are going to get 8%, fixed income is going to get 8%, so you might as well put it in fixed income, right? But I was one of those who was contrarian to that, say that why are you locking to 8% for 1 year, for 3 years with then the taxation rules on fixed income, when in the second and the third years, equities are going to deliver upwards of 15%. So over a 3 year, you'll make much better returns. And today, 6 months down the road, mid caps have delivered 12.5%. So small caps have delivered 13.5%, and large caps have delivered 7%. So clearly, you can see that the broader market has delivered a very close to nominal GDP in terms of growth. So I don't think there's need to worry about that from an investor perspective. Second thing is that if you look at the FII flows, right, from COVID, right, when the oil price dropped, and I keep bringing back this point because I firmly believe that the volatile FII flows track oil prices. So when COVID, the prices crashed, something like 2.8 lakh crores of FII money came in 6 quarters, beginning of COVID till middle of June 21, right, September 21. In 3 months, when oil went all the way to 125, 90% of that money went out. Out of 2.8 lakh crores, 2.5 lakh crores went out, right? And then when oil started crashing from 125 down, in just 2 quarters, 95,000 crores of money came in. It would have continued, but oil stabilized at that time because of the price cap and Putin countering that. And the Adani and the banking crisis led to some 30,000 crores of outflows. So if you then take a balance sheet at the point of 31st March, right, which is when the outlook was so negative at that point of the whole thing about India and everything, right, there was still 1.8 lakh crore of FII money which came in during COVID, which went out during the oil price hike, which has yet to come back in. And I've been saying since then that this is what is going to drive the market up. Now, what has happened since April to now, out of that 1.8 lakh crore, 1 lakh crore has come in. So my point is very simple. There's 80,000 crores of FII money, which was in the Indian market post-COVID, which is waiting on the sidelines just to see clarity on whether oil is going to be stable going down, is India's growth story intact, and is the world liquidity interest rate story intact in terms of providing adequate liquidity for hedge funds to borrow and invest. I believe all those points are well on place. So I think another 80,000 crores of flows combined with the fact that first time when FIs came in COVID, domestic investors were selling. Remember that?
Yes.
At that time, and now today domestic investors are buying. So I see that, I think Pankaj made this point, long-term valuations, India is trading around its average, around its mean. Whereas during the October 21 peak, we were at about 23 PE, and in the December 17 peak, we were at 25 PE. So either you look at it as a 15% or a 20% upside from the current 20 forward PE for the market, if all other things remain equal, which is oil prices and the monsoon risk at bay. So I think there is enough upside in the market. People, mid and small cap, they should continue doing it through the SIP route and through, as Ajay mentioned, through fund managers. But I think in the large and mid cap and those kind of space, I don't think you'll go wrong if you do a lump sum investment with a 3 to 5 year outlook.
Okay, so that's a great roundup of where we are right now. It's looking good so far. Fantastic beginning to July, and we hope that with the progression of the monsoon, there is that kind of growth in your portfolios as well. Thank you so much to all of you for joining us on the show this evening. We'll take a very short break, but stay tuned. We're coming back with a lot more.